cut schedule, I think I will affected around 10:30. So therefore, I am starting. If that kind of things happen, so I will upload the video for the remaining parts in the lecture. Anyway, I will try to continue with the laptop. But anyway, I think after the power failure, there will be a network interruption also. Sometimes might not be possible, but anyway, we'll try. So I'm starting recording also now.
Recording in
So you
progress.
can see we are on the discussion of capital budgeting. I hope that you remember that we discussed certain things related to the capital budgeting in the last session. That is, what is capital budgeting? Especially in simple, capital budgeting means the process of taking long-term investment decision. So it is a very responsible job that financial manager is responsible. This is very difficult, that's a very complicated part that financial manager should be responsible. So this is a process, as I told. So in this process, it includes certain steps. So we are not following every steps in this lesson, but we are focused more towards to the evaluation techniques. In the last day, I explained certain types of capital budgeting projects like mutual exclusive investment, like independent and dependent projects. So I think you may remember. So today I am just moving to that cash flow. Certain things I am discussed related to the cash flow estimation. So this is the process actually. So in this process, at least these steps are included. So here we are not going to touch every steps, but anyway, our focus more towards on this evaluation, or we discuss more capital budgeting evaluation techniques. But anyway, to a certain extent, I expect to explain how we estimate the cash flow. This is very difficult part in the capital budgeting, because forecasting cash flow for a future for 5-10 years is very difficult, because economic conditions can change. There are certain things to be happen, uncertainties there. So therefore, that forecasting cash flow is very difficult. But anyway, without identifying or without forecasting cash flows of the project, you can't evaluate. You can't evaluate. So to evaluate, you should know what are the expected cash flow. What is the initial annual operating cash flows? And also you should know what is the terminal cash flow of the project. So this part is very difficult, but anyway, with a very simple example, I will explain how to identify the cash flows, very simple format. Then after identification or after forecasting the cash flows, you can assess risk of the project, and also you can determine cost of capital of the project. If project risk is equivalent to the firm average risk, so then you can use company cost of capital for project evaluation. But anyway, in practically, you know that projects are having different degrees of risk. So therefore, using the company cost of capital, not realistic. So therefore, for the projects, you have to identify its cost of capital. So therefore, that adjustment you have to do. But anyway, if the average risk is same, project risk is same as the average risk of the company, then you can use the firm or the company cost of capital. So our focus, we are use evaluation techniques like NPV, IRR, payback period, profitability index, like things to evaluate the projects. So those are the things actually there we are going to cover. So first we'll see this estimate cash flows. In a project, there are basically three types of cash flows. Initially, you have to identify initial investment, or we call initial outlays or initial cash flow. Then throughout the project, during the lifetime of the project, you have to identify operating net cash flow, annual operating net cash flow after tax basis, right? After tax net operating cash flows over the life of the project, annual operating cash flow. Finally, you have to identify terminal year cash flow, terminal after tax non-operating cash flow. So basically, related to the project evaluation in investment, you should know what is initial investment, what are the annual operating cash flows, and what is the terminal cash flow. So without estimating, without forecasting these cash flows, we can't do this part. Evaluation of the project, not possible. So therefore, this is very difficult. Forecasting cash flows is very difficult. But anyway, to get a rough understanding about these cash flows, I will explain with some very simple example. So initial cash flow, initial outlay of we call for a new investment, or it can be a replacement. If it is a new investment, new project, so initial cash flow is equal to the fixed capital, or we call investment in new fixed capital, and plus increase in the net working capital. So with the new investment, there is a increase in net working capital, short-term current assets and current liabilities. You have to invest them. So there is an impact to the working capital. So initial cost or initial outlay is equal fixed cost or initial cost of the project plus increase in the net working capital or investment in the net working capital. So required short-term assets. So therefore, you have to invest in the receivables, inventories, materials, and also there can be a short-term payables that is generated by the project. So that part you have to increase in the net working capital should be subtracted. Sorry, increase in net working capital means it's a cash outflow. So therefore, you have to subtract that. So therefore, better if you can put here like this, plus or minus, change in the net working capital. Increase in the net working capital, you have to subtract it. If there is a decrease in the net working capital, that means it's a cash inflow. So then you can add it for the cash flow. So normally when you estimate the terminal cash flow, there is a releasing of the net working capital. So it is a cash inflow to the point. Normally at initial point, when we estimate the initial cash flow, there is an increase in the net working capital. So this is a cost. So therefore you have to subtract. Right. So anyway, with the example, you can understand. Anyway, when you estimate the initial cost, you have to adjust fixed cost, installments cost can be there, carrying charges can be there sometimes. So then you have to adjust it for the net working capital increase in the net working capital. Right. So then the next one is the if it is a replacement project. If it is a replacement one, this is actually for the new investment. If it is a replacement project, then in addition to this fixed cost investment and the net working capital investment, you have to adjust the salvage. For the existing machine, for the existing asset, there are sometimes a salvage. Right? So if you are getting some salvage value from the existing one, then you have to deduct it amount from the initial cash flow when you estimate the initial cash flow, cash proceeds or salvage from the sales of the all fixed capital or all assets or the existing project. And also you have to do the tax adjustment based on the salvage, right? If that particular asset, if it is totally depreciated during that project or that lifetime of the asset, if that asset is totally depreciated, then salvage is a profit. Salvage value is the profit. So therefore, based on that salvage value, you have to pay tax. You have to pay tax. So that is the cost. So therefore, you have to calculate the tax amount on the salvage. So you can identify whether it is a profit or loss like this: salvage minus book value. B0 means that is book value of the all fixed capital or the all fixed asset. So if it is totally depreciated, this book value, right, then this is a profit. Salvage value is a profit. On this profit, you have to pay tax. So that is you have to adjust in case of the replacement investment. When you estimate the initial cash flow or initial outlay, initial cost of the project. Right? So this is for the replacement one. This is for the new investment. Then this is same thing, right? Nothing new. I have yes, exhibited in a different way. Cost plus the installation and shipping. Then plus increase in the net working capital minus net proceeds from the sales of the existing asset plus or minus tax associated with the above salvage value. So then this is the initial cash outlay, initial cash cost of the project. Right. The next one is the annual after tax net operating cash flows. For each year during the life of the project, you have to identify annual net operating cash flow. You have to understand, you have to identify cash inflow and cash outflow. You have to consider the depreciation, and like this, you have to identify annual net operating cash flow for each year in the project. So consist of annual cash flow occurring from the operation of investment, but it is also be affected by changes in the net working capital and capital expenditures during the life of the investment. So these capital expenditures normally we are just in using the depreciation. The computation of the after-tax cash flows require careful treatment for the non-cash expenses items such as depreciation. So you know that depreciation is a non-cash item. Is a non-cash item. So therefore, when you estimate the annual net operating cash flow, the amount of the depreciation you have to add back. We consider depreciation for the tax purpose because we deduct depreciation to derive the net profit. On the net profit, we have to pay some tax. So the tax purpose, we deduct depreciation. But anyway, remember that depreciation is a non-cash item. So therefore, when you estimate the annual net operating cash flow, you have to net income, you have to add back the depreciation to the net income to identify the annual net operating cash flow. With the example, you will understand this because this depreciation is a non-cash item. It's a provision, is a non-cash item. So depreciation calculated as per the income tax rules influences cash flows indirectly by way of depreciation tax shield, because on the depreciation, you are getting tax shield because depreciation is a tax deductible expense. Right? So therefore, you will get some tax shield. So in order to calculate that amount correctly, you deduct depreciation when you estimate, when you derive the net income. But anyway, when you estimate the net cash flow, this depreciation, you have to add back. Right? So annual after-tax net operating cash flow over the project's life, you can calculate like this. Annual net operating cash flow. Sales, S is the sales. Sales minus cash operating expenses. Operating expenses. So from the sales, you have to deduct the operating expenses, and also D is the depreciation. So this is then net income. Net income. On that you have to pay tax. So therefore net income you multiply by the 1 minus tax rate. So this is the after-tax net income. Then you add back this depreciation. In order to get the cash flow, this is the net income after tax. So you have to add back the depreciation, right? So like this, this is one way, and also you can look at the next one. So this is sales minus cost, and then without depreciation, this is the net income. On that you have to pay tax. So 1 minus tax rate. And here you add tax shield. This is also possible, depreciation into tax rate. So that on the depreciation you are getting the tax shield. No? So to this, if you add the tax shield, so that is the annual net operating cash flow. So you can follow either this method or this way. But anyway, this is very clear what is we are applying in the income statement. Normally from the revenue, we deduct all the cost, including depreciation. On that we tax, on that we calculate tax amount, and then you have to add back here depreciation, because this is a non-cash item. So in order to estimate the cash flow, you have to add back the depreciation. So this is how we estimate annual after-tax net operating cash flows. For each year, you have to estimate this, right? So then terminal year cash flow, or we call terminal cash flow. This is non-operating tax, after-tax non-operating cash flow. So in the terminal year, you can see there might some salvage value again. In the terminal year, if there is a salvage value in the project, so that you can sell. So you will get some cash proceeds from the salvage, right? So SALT mean cash proceeds from the sale of fixed capital on the termination date. That is what we call the salvage value. Then you have to adjust the net working capital change. Now here at the terminal year, there is a increase in the net working capital. Not the increase in, that is we sell the existing capital assets. So therefore, actually not the increase in, that is a decrease in the net working capital. So that decrease in mean it is a cash inflow. So then you can add to the terminal year cash flow. අපි තියෙන current assets අපි release කරනවා. project එක ඉවරයි. එතකොට එතන release කරනවා කියලා කියන්නේ අපිට එතන cash inflow එකක් හම් වෙනවා. So the decrease in the net working capital is a cash inflow. Then on the salvage value, again you have to deduct tax, because if the asset is totally depreciated, the salvage value is a profit. On that profit, you have to pay tax. So this is terminal year net operating, non-operating cash flow. So at the end of the project, you have to estimate the cash flow like this way. Right. So with the example, now I will try to explain this estimation part of the cash flows: initial cash flow, annual net operating cash flow, and terminal year cash flow. Just look at this example. This is very simple one. So with that, I think you will realize this estimation. You can read. Consider an investment cost include 200,000 rupees outlay for fixed capital items. This outlay includes 25,000 rupees for non-depreciable land plus 175,000 rupees for equipment that will be depreciated straight line to zero over 5 years. Right? So the project cost is 200,000. It includes 25,000 non-depreciable land and also some equipment, 175,000. So that is depreciable on straight line basis. So the project life is 5 years. Throughout the 5 years time, this is straight line to it is depreciating to the zero. The project requires 50,000 rupees of current assets, but generates 20,000 rupees in current liabilities. So this is the change in the net working capital. Requires 50,000 current assets, but generates 20,000 current liabilities, resulting in a total investment in net working capital of 30,000 rupees. The difference between the current asset and the current liability, 30,000 rupees. Each year sales will be 250,000 rupees and cash operating expenses will be 90,000 rupees. For each year throughout this 5 year, sales 250,000, cost operating expenses 90,000. Income taxes at a 40% rate. At the end of the year 5, the company will sell off the fixed capital asset, including the land, as all for the 50,000. So this is salvage value. At the terminal year or at the end of the project investment, you can sell this fixed capital asset for the 50,000. Additionally, the net working capital investment rupees 30,000 is recovered because short-term assets such as inventory, receivables, and the short-term liabilities such as payables are no longer needed for the projects. So therefore, there is a decrease in or release in of the net working capital. So this is the cash inflow at the end of the project. The investment project has a required rate of return 10%. So this is the question. This is the example. So now on this example, you have to estimate these three cash flows. Estimate initial cost, annual operating cash flows using this formula, and terminal year cash flow. So then you can understand how to estimate the cash. This is a very simple one. Right. So first estimate year 0 cash flow. So this is a project with the 5 years. 0, 1, 2, 3, 4, 5. Right. So this is the initial cash flow you can estimate for here. That is the cost of the project. For the cost of the project. So then estimate the annual net operating cash flows for this 5 years and also here terminal cash flow. Because that lifetime of the project is 5 years. So then therefore you have to estimate the terminal year cash flow here. So this is the project. Can you get bit attempt? So I will explain without no doubt. But anyway, just try to at least identify the cash flows. I will let you 2 minutes. So I think we can discuss. So this is the question. I think now we are working on it. So first, initial cash flow or the investment cost. Initial cash flow or investment cost you can work out, because here uh, fixed total investment cost 200,000. It is 200,000. In addition to that, there is a increase in the net working capital finally by 30,000. Current assets by 50,000, liabilities by 20,000. So the net working capital increase is 30,000. Cost capital as current assets. So therefore, we have to consider this thing for initial cash flow. Cost is 200,000. Fixed capital is 200,000. Right. So increase in the net working capital. Here, increase in the net working capital mean is a cash outflow, is a cost. So therefore, it's also you have to add as a is a cash outflow. So minus I have put here. Then total cost of the project is 230,000. 230,000 at the zero initial year. Total cost of the project. I think it's clear. Then you have to estimate annual net operating cash flows for each year. Now here, if you go to the question, you can see each year sales will be 250,000 and expenses 90,000, income tax at 40% rate. So you can work out the depreciation here. How much the depreciation? Because this is on straight line basis. So therefore, you can estimate the annual depreciation in this 200,000, 25,000 is non-depreciable land. So therefore, don't depreciate the land. It is a non-depreciable one. So therefore, 175 is the depreciable amount investment. 175 divided by 5, that is 35,000. So annual depreciation is 35,000. That you can consider. So here sales is 250,000, operating expenses 90,000, annual depreciation 35,000. So operating income before tax. So we have to here from the sales you have to deduct these things, right? These are cost. So you can see operating income before tax 125,000. So tax at the 40%, 50,000. Then operating income after tax, after deducting the tax, operating income after tax 75,000. Then what you have to do, you have to add back this depreciation. This is a non-cash item. So therefore, for the net income or the operating income after tax, you have to add the depreciation. Then net operating annual cash flow for the year one is 110,000. No. In the question, one of you ask in that question, operating expenses does include the depreciation? No. Just assume that depreciation is not included in this operating expenses. You have to work out the depreciation, right? If it is say that operating expenses are included depreciation, so no need to get the 35,000 again. But anyway, I suppose here that depreciation you have to work out and you have to deduct it separately, right? Just assume that. Okay, that's a good question. Anyway, in exam, I will give the question very clearly. Operating expenses as without depreciation. Consider this as a without depreciation, right? So then you will get for the year one after tax operating cash flow. It is 110,000. So same way you can work out annual operating cash flows for the year two. I think now it is clear. From here, you have to deduct this because operating expenses are same. You have to deduct these things. And operating income same. Then so likewise, you will get the same value. For every year, get the same value. Even year 5, you will get the same value. Okay. Then this annual operating cash flow, you have adjusted for the terminal year because this is the terminal year of the project. From here, the project is over. So therefore, this 110,000, now you have to adjust for the terminal expenditures and the terminal cash inflows and the cash outflows. So that is you have to adjust. Then terminal year after tax operating cash flow, you can estimate if you go to the question again, you can see at the end of the year 5, the company will sell off the fixed capital asset, including land, for 50,000. Additionally, the net working capital investment 30,000 is recovered. So there is a sales of the current assets, so the decreasing in the net working capital. So recovered means, so that is cash inflow. Then required rate of return is 10%. Right, now you can calculate the terminal year cash flow. All this investment you can sell at the end of the year 5 for 50,000. So now this 175,000 equipment, 175,000 equipment is totally depreciated within these 5 years. Because on the straight line basis, now it is totally depreciated. So therefore, this 50 in this 50,000, the salvage value is a profit. From this 50,000, you have to deduct the non-depreciable land. 50,000, you have to deduct the non-depreciable in order to get the tax amount, right? Because on the salvage profit, salvage cash flow, you have to pay tax. දැන් මෙතන salvage value එකේ profit එකනේ තියෙන්නේ. මොකද equipment totally depreciate වෙලා තියෙන්නේ. එතකොට හම්බ වෙන salvage value එක මත අපි tax එකක් ගෙවන්න ඕනේ. So you have to pay the tax. Then from that you have to deduct this land. This is 25,000. Then 25,000. On this 25,000, you have to pay 40% tax. You have to pay 40% tax. So then tax amount is equal 10,000. 10,000. 10,000. So therefore, now from this income that you are getting from selling this cash equipments and the land, from this 50,000, you have to deduct 10,000 because that is tax is 10,000. I will go to the formula if you are confusing this one here. On that salvage value, you have to pay the tax. So that you have to deduct. Now here it is 10,000. This is 50,000. From 50,000, you have to deduct the 10,000. So then amount is equal 40,000. After tax salvage value is equal 40,000. This is how this 40,000 is arrived. Then releasing the net working capital is a cash inflow. This 30,000 you can add back, right? Return of the net working capital 30,000 you can get. Then total 40,000 plus 30,000, 70,000. Then after tax total cash flow, this 110,000 you have to add to the 70,000. So the terminal year total cash flow is 118,000. So this is how we adjust the terminal year salvage and the release in the net working capital. So now you know the cash flows of the project. Initially, this is 230,000, cost is 230,000. Annual operating cash flows is 110,000. Here also 110, here also 110, here also 110. Year 5, it is 180,000. Now on this, you have to evaluate the project. After estimating these cash flows, now you can evaluate. Now you can calculate NPV, IRR, payback, profitability index, and see whether this project is feasible or not. So estimating these cash flows are very difficult. Not much easy like we done in this example. Forecasting the cash flows for the uncertainty future. There are certain economic crises, economic this is the very, very difficult part in the capital budgeting. Estimating the cash flows. Right? This is for only 5 years, but when we say the capital budgeting project, it goes beyond the 5 years, maybe 10, 20, 15 years. So then forecasting cash flows, see, think about the difficulty, complexity of the estimating cash flows with the inflation and the real options, economic and change. So you have to connect with the probabilities even. Now here we just simply estimate on the given data, but anyway you have to consider here probabilities of happening the economic conditions. On that probabilities, you have to estimate the cash flow. You have to do the sensitivity analysis, right? So that anyway, this is very difficult part, but here in your introduction of this capital budgeting, you have to just understand before going to the evaluating of the project, the estimating of the cash flows, you have to do like this. Initially, you have to identify initial cost, annual cash flows, and the terminal cash flow. Right. Now we have done it. Now we are going to the projects evaluated. After estimating the cash flows, now you can evaluate the project. For evaluation, basically we are using discounted cash flow based project evaluation method as well as non-discounted cash flow based criteria. Can anyone explain me what is this discounted and undiscounted? Just simply say if you are realize these concepts very effectively and if you know the matters very well, so you can explain what is the meaning of this discounted and non-discounted. Anyone, please?
Adjusting the time value of money.
Yes, correct. Discounted means that is adjusting the time differences. Because now, if you look at here in our early example, right, this 110,000 you are getting 1 year from today, forecasting 1 year from today. This is 3 years from today. This is 5 years from today. So there is a time gaps, time differences. So once you adjusted these cash flows for these time differences, we call it as a discounted cash flows. We call it as a discounted cash flow. You are correct. One of you have asked me a question. Is required to calculate tax on loss disposal. No. Land is no, not on the 25. You are asking that tax on disposable assets also, because that land is not the depreciable one, so that is cost. No. Now in this example, this 25,000 is the cost of the land. Cost of the land. එතකොට අපි මේක මත අපි depreciation එකක් ගෙව්වේ නැහැ. එහෙනම් මේ value එක හැමම තියෙනවා. එතකොට at the end of the project you are getting 50,000 as the salvage value. On this 50,000, you have to deduct this 25,000. This is a cost. This is a cost. So that's why I deduct this one. So then this is the profit. 25,000 is the profit. On this 25,000, you have to pay tax 40 at the 40% rate. Then it is 10,000. Then this 50,000 cash flow, you have to deduct the tax, that is 10,000. Right? Okay. Right. So now we are going to discuss these criteria. So first, payback period, net present value, internal rate of return, profitability index. Under the internal rate of return, I will explain modified internal rate of return. And also finally, we will look at how we treat the project when there is a different lifetimes. That means one project is 2 years, other one is 4 years, so likewise. So we will discuss bit on that. And also you will learn economic life and the project life. So that difference also finally I will explain. So what is payback period? Very simple, for anyone can understand. Payback period is the number of years required to recover the initial cost of the project. Number of years required to recover the project cost. How long does it take to get the business money back? So that is the payback. අපි සිංහලෙන් කියනවා පිළිගෙවුම් කාලය කියලා. So simply number of years required to recover the cost. Now if you look at these two projects, S, L and S, projects cost is given. Now here all the data is given. Cash flow estimated are given, and also project cost or the required rate of return is given. So you are receiving a question like this. We are not expecting you to estimate cost of capital, cash flows, but anyway you should know it is not the capital budgeting. Capital budgeting is process. That process include identifying the projects, for estimating cash flows, estimating cost of capital and the risk of the project, and then evaluating the project. So we are jumped to the evaluating part. So with the given word, all these things are given. Right. So now here, simply what is the payback period for the project L? Payback period is number of years required to recover this initial cost. Simply for the project L, how many years it takes to recover the 100,000 cost? Now you can see the project cost is 100,000. What is the payback for the L?
2 years and 4 months, madam.
2 years and 4 months. We'll see, right? So yes, 2 years it goes. Yes, within the 2 years you can recover 70,000. So remains 30,000 to recover in the year 3, right? 30,000 to recover in the year 3. But year 3 cash flow is 80,000. So then simply you can look at argument like this: 2 years plus, if 80,000 around in 12 months, how many months it required to 30,000? Simply by solving this formula, you will get the payback. You are getting the same answer: 12,000 divided by 80,000 into 30,000. 2 years and 4 months. The answer, Kirawa?
2 years and 4 months, madam.
Yes. This is 2 years and say around 4 or 5 months. This is the payback. So likewise, you can calculate it payback. This is based on the non-discounted cash by taking the cash flow as it is, right? Without adjusting them for the time differences. So you can just to practice how much the payback for the project is. Tell me, anyone, what is the payback for the project is? It is 1 year and
7 months.
7 months. Yes. Now, if you ask to compare this project based on the payback, so you will get project LOS. The pay, you will take the S. But yeah, because the payback is compared to the project L, it is less for the project S. So therefore, you may select the L, right? But anyway, as a technique, payback period has certain limitation. So without using payback only, normally we are not getting decisions. We use different techniques, different tools, and then we analyze them, and then finally we take the decision. So when you take the payback, it has some weaknesses as well as some strengths. As a strength, you can see provides indication of the project's liquidity. Very simple. Now here, the cost of the project is, you can recover by 1 year and 7 months. So the liquidity is high for this project. Liquidity is high. What is the liquidity? Liquidity means is the possibility of the recovery in your investment. Normally, for an investor, liquidity is it is the ability to recover your initial investment without certain significant loss. So this is an indication of the liquidity. Now here for the project L, liquidity is high, liquidity is low. So, and also it shows the project risk. Now, if I ask the question, by considering this project L and S, which one has high risk? L or S? Project L or S? When you have to wait long period to recover the certain cash flow, with the time value of money, you learn that what is the time value of money? Money receiving today more valuable than money receiving tomorrow. So when you have to wait long period, long time to recover to get some money, so it increase with the time, it increase risk. So now project L, because it takes 2 years and 4 months to recover initial cost. You have to wait 2 years. But for the project S, within 1 year, you can recover. So therefore, the risk of the project L is high. This project risk is low compared to the L. So therefore, this payback period is an indication of project's liquidity as well as the project's risk. So simply you can get it as a strength of this payback period. Easy to calculate and understand. This is very simple. Even to the layman can understand what is the payback. No need to have a finance knowledge. Weaknesses, it ignore the time value of money. So you know that we calculate the payback period, get in the cash flows as it is. Getting them as it is without adjusting them to the time. So it ignore the time value. This we can overcome by calculating discounted payback period. This limitation you can overcome very easily by calculating discounted payback period. But anyway, this limitation, ignore the cash flow occurring after the payback period, even in the discounted payback, non-discounted payback, this limitation is there. Because payback period just say when you can recover your cost. But it doesn't say anything what happens to the project after the payback. Whether the project goes to 10 years or 5 years, what about the cash flows? Are there cash inflows or the outflows? Pattern of the cash flow. So you can't get anything, any sense about that with the payback period. It says where the cost you can recover, when you can recover the cost. It doesn't say anything related to after the payback period. So therefore, this is a very big limitation. Even with the discounted payback and the non-discounted payback, you can't sort this. Right. So what is discounted payback? Now it is clear. You told that when you calculate the payback period on the discounted cash flow, time adjusted cash flow, that is we call discounted payback. But I tell earlier, still fails to consider the cash flows after the payback period. Now here, if you calculate the discounted payback, so here discount rate or the required rate of return is 10%. So here for the project L, just see, you have to calculate present value of the cash flow at 10%. So you know that how to calculate the present value, 1 divided by 1 plus R into the power n. For this is for the year 1, year 2. So year 3, likewise, you can calculate the present value interest factor. I think you may remember the time value of money. This factor you can multiply by this cash flow. So then you will get discounted cash flows, right? So those are the present value. Now in this timeline, if you draw the timeline here, 0, 1, 2, 3. The expected cash flow, year 1, 10,000. Year 2, 60,000. Year 3 for the project L, right? 80,000. Time adjusted cash flow is 9,091. This is in the level of here. This is actually here. We discounted all cash flows to the 0 now. in the same level. This is also we discount to the 0, 49,587. Year 3, non-discounted cash flow 80,000. Once you discounted it, when you adjusted this 80,000 for the time difference, that is 60,105. Now calculate the payback. Simply based on the discounted cash flow. How much the payback now? How much the payback now? It is within first year you can recover only the 9,091. So then still remain 90,909 to recovered in the initial cost. From the second year, you can recover 49,587. So at the end of the year, two still remains 41,322. So that you can recover in the year 3. So then approximately payback for the L now is 2 years and 8 months, around 8 or 9 months. Earlier it was 2 years and 4 months. Now further payback has extended 2 years and 8 months. Now payback is 2 years and 8 months. So likewise, this is how we apply the payback to evaluate the project. One very important thing, when you apply payback to compare the projects, remember that when you apply the payback to compare the projects, the initial cost of the project should be equal, right? When you apply the payback period to compare two projects, look at the initial cost, right? That initial cost of the project should equal. Otherwise, you can't apply the payback. So that is very important point. If you need, you can point out this. Without equal initial cost, you can't compare projects with the payback period. That is, you have to remember. Right. So the next one is NPV. This is very important one. This is what we use very frequently. This is very theoretically very strong one. It's aligned with our objective of financial management also, NPV, or net present value. Net present value is simply difference between the present value of the cash inflows and present value of the cash outflow. Here we are using the very conventional type project. So therefore I have put the term cost here. Rather than saying the cost, better to mention here present value of the cash outflow. So difference between the present value of the cash inflow and present value of the cash outflow is the NPV. It can be positive, negative, or 0. 0 means present value of the cash inflow is equal to the cost. Marginal project is a marginal project. Positive means present value of the cash inflow is greater than its cost. Negative means present value of the cash inflow is less than the cost. Normally our acceptance criteria, when the NPV is positive, we accept the project because it creates some wealth. It creates some wealth, value to the firm, that project. If the positive NPV is there in the project, it means that from that amount, that project creates value for the business, value for the company, value for the owners. So therefore, when the NPV is positive, we accept the project. When NPV is negative, we reject the project because it decreased the value from that much. If say NPV is minus 170, it means if you accept this project, your wealth, your value will decrease by 170. There is no value maximization, value or the wealth maximization. Your wealth is decreasing. If it is 0, it is marginal project. No increase or no decrease in the wealth value. So therefore, either you can accept or you can reject. So this is the very decision criteria. It is very clear. Mathematically, is very clear. Based on that, you can take the decision. So, if you look at the strength and weaknesses of this NPV or the net present value calculation, this is fundamentally theoretically very strong method. Even today, we are using this is very frequently and also most popular one. This is the one we consider as the most superior method of the project evaluation. Even it's consider the time value because we calculate present value of the cash inflow and the cost, present value of the cash outflow. So it consider the time value of money. In NPV calculation, remember that there is an implied assumption, right? These cash flows we are reinvesting at the cost of capital. When we calculate the NP, there is an implied assumption. What is that? Cash flows are reinvested at cost of capital throughout the life of the project. මේ NPV එක අපි calculate කරනකොට මේක ඇතුලේ ඒ implied assumption එක තියෙනවා. දැන් මේ 10,000 cash flow එකක් we are generating 1 year from today for the on the project L. 60,000 on 2 years from today. And the project life is 3 years. So this 10,000 we are reinvesting for 2 years at the 10%. This is our cost of capital. This is our project cost of capital, required rate of return. So that implied assumption is there behind the NPV calculation. Reinvestment rate is cost of capital. I think it's not included here, but remember that when we estimate the net NPV, there is a reinvestment assumption. We reinvest the cash flows at cost of capital. At cost of capital. ඒතර ඒ පදනමේ ඒ බේස් එක implied assumption එක තුල තමයි මේ NPV එක එන්නේ. ඒ reinvestment එකත් එක්ක ඒ reinvestment profit එකත් එක්ක තමයි මේ NPV එක එන්නේ. ඇයි අපි මෙතන ගන්නෙ compounded cash flows? Always in finance, I think at the very beginning also I told you that reinvestment assumption is very strong. Once you get the cash flow earlier, you are reinvesting it for the time plan or your investment horizon. So then you will get the compounded return, not the simple return. It's a compounded return. This 10,000 is compounded for the 2 years. On that way, you are getting the NPV. Right. So then if you calculate the NPV for the project L, so this is 10,000, 60,000 and 80,000. So you have to calculate present value of the cash inflow and the present value of the cash outflow is 10,000. No need to discount it because here it is at year 0. Now how much the NPV here? Simply you have to discount this 10,000. This is 60,000. This is 80,000. So discount rate is 1 upon 1.1 into the power minus 1. Here 2 years. This 60,000 you have to discount it for 2 years. 1 upon 1.1, 2 years. This is not the minus, right? 1 year, 2 years. This is 1 over 1.1, 3 years. So you will get the present value factors like this. Then factors you have to multiply by the cash flow. So what are the cash flows coming here? Oh, what is the NPV for the project L? Is it 18,790? Did you get this value? This is the NPV for the project L. NPV. Did you get this value?
Yes, ma'am.
Oh. So similar way, you can calculate the NPV for the project S. This is 19,980. This is 1,000, 18,790. This is 19,980. Now, if the projects are independent, which you may select? Let's assume that projects are independent. They are for the different purposes. I think you remember the independent and mutual exclusive project. If they are independent, which you may select?
Project S, madam.
They are independent. They are for the different purpose, different objective. These two projects for the different purpose. They are independent. That is mean they are independent. No. So if they are independent, are you selecting one or both?
Both, madam.
Both, because both NPV for the both projects is positive. So you can select both projects. If they are mutually exclusive, which one you may select? If they are mutually exclusive, they are for the same purpose.
Yes, madam.
Yes, you select X. Why? It is the one with highest NPV. So you may select the one with the highest NPV because it creates highest value if you accept this project S. So likewise, you can take the decision based on the net present value. So this is about the NPV, net present value calculation. So based on the NPV also you can evaluate projects like this. Remember that when you are calculating NPV, the implied assumption, the cash flows during the project, cash flows of the project during the lifetime of the project, they are reinvesting at cost of capital. So on that assumption, we calculate the NPV. So the next one is the IRR, or we call internal rate of return. අපි මේක සිංහලෙන් කියනවා අභ්‍යන්තර ප්‍රතිලාභ අනුපාතය IRR. So what is the IRR? It is the rate of return that particular project is generated intrinsically, internally from that particular project without influencing, without affecting any external factor. It is the rate of return that particular project is generated intrinsically. I think you may remember in the bond valuation, you calculate YTM, yield to maturity. What was the yield to maturity? If you purchase this particular bond today at the prevailing market price, and if you keep this particular bond until its maturity, the realized rate of return, we call it as a YTM. So it's internal rate of return. Investment එකේ අභ්‍යන්තර ප්‍රතිලාභ අනුපාතය. So likewise, this we same YTM is equal to the IRR, same meaning. So IRR is the internally generated rate of return. IRR is the discount rate that forces present value of cash inflows equal to the present value of the cost. That means it is the discount rate when NPV is 0. Technically, when you estimate the IRR, technically, it is the discount rate or it is the rate of return when NPV is 0. NPV 0 meaning present value of the cash inflow is equal to the present value of the cash outflow. NPV is 0. So IRR mean it is the rate of return or the discount rate when NPV is 0. I think you may remember that IRR you have to calculate. In the Excel, you can use the IRR function. There's an inbuilt function. But anyway, in the exam, you have to use trial and error method. You have to use trial and error method. From the trial and error method, you have to identify a feasible range. On this feasible range, you can do a linear interpolation. Approximately, it will give you the IRR. So that way, you have to work out IRR classroom. Right? So mathematically, IRR is this one. This is the IRR. It is the rate of return when NPV is 0. So you have to solve this for the R. In financial calculators also you can do very quickly. But anyway, we are using the this trial and error method to calculate the IRR. Now, same project here. In the IRR calculation, there is an implied assumption that is also very important. We assume that cash flows of the project are reinvesting at IRR. But in the NPV, the reinvestment rate was the cost of capital. In IRR calculation, cash flows are reinvested at IRR. එතකොට අපි IRR calculate කරනකොට අපේ reinvestment assumption එක නැත්නම් implied reinvestment assumption එක project එකේ cash flows අපි reinvest කරන්නේ at IRR, not at the cost of capital. Right? If IRR is greater than the cost of capital, we accept the project. The decision criteria, once you calculate the IRR, in order to take the decision regarding the project, you have to look at the company cost of capital. If IRR is greater than the cost of capital, you may accept the project. If IRR is less than the cost of capital of the project, you may reject. If IRR is equal to the cost of capital, either you can accept or either you can reject. So likewise, it is the decision criteria with the IRR. IRR is the project intrinsically generated rate of return. So that rate of return you have to compare with the firm company cost of capital in order to take the decision. Right. So now we are on the same example still. LNS projects. For the project L, now if I ask you to calculate the IRR, so what is the method you are using? Simply, what is the IRR for the project L? If you go to the Excel, simply you can calculate IRR. Nothing to worry, just include the cash flows. This is cost is 100,000. Year one, 60,000. No? 60,000. No, 60,000, 10,000. 10,000. Year two, 60,000. 80,000. So in the Excel, it is very easily you can calculate without much trouble. Simply go to the function. Go to the IRR here. Select the values. So 18.1. It is the IRR. So in the Excel, you can calculate like this. Then this IRR you have to compare with the cost of capital. But anyway, for the exam, you have to go with the trial and error method. In the exam, I think most of you are not using the financial calculators. In the scientific calculators, I think you can't enter the formula. But if you are familiar with the financial calculators, possible. So therefore, what is we expect? You have to look at, you have to go with the trial and error method. Trial and error method. So what is trial and error method? I simply explain. So you have to calculate NPV based on any guessing value. Based on any guessing value. Simply I take 16% without any rational. Simply what I feel, I took the 16%. You can take 20%, you can take 10%, you can take 8%. So whatever the value is a starting point, is a guessing value. So I calculate the NPV at 16%. It was 4,463. Right? in the exam, sometimes you will get the marks for the steps because you can write the IRR by asking from someone also. No? But if you follow the trial and error method, we can see the steps that you attempted and then you can give some marks. But anyway, don't worry about that, you will get the marks, right? But anyway, you should know without knowledge of the calculators, Excel, even if you need to calculate the IRR, you have to go with this trial and error method. So simply I calculated the NPV at the 16%. See, it is positive. It is positive. So now I want to identify a range where the NPV is 0. IRR means it is the discount rate where at the NPV 0 no. IRR කියලා කියන්නේ NPV එක බිඳුව වෙනකොට discount rate එකනේ. So therefore I will try with another rate. Then I want to reduce the NPV. I want to decrease the NPV. In order to decrease the NPV, I increase the discount rate. I increase the rate. So then I will calculate the NPV at this 19%. So you will see it is negative. Now positive and negative NPVs are there. So in between this positive and negative, 0 is there. So therefore this is the my linear interpolation table. So the range is okay now. So I want to calculate this one. Rate of return when the NPV is 0. So therefore, I am using this linear interpolation method. I have explained this in somewhere I remember. So then it is greater than 16%. Here, difference between the large value and the small value. So we call delta 1. So that difference 4,463 minus 1,753. That is 6,216. For that difference, the rate difference is only 3%. May difference eකට rate එක differ වෙලා තියෙන්නේ by the 3%. Then for this difference, this is say delta 2. This is 4,463. For that difference, this 16% should include by how much? So this is the simple argument on this formula. For this difference, if the rate is differed by 3%, for that difference, rate should differ by how much? Then you will get the IRR simply 18%. This is how we work out the IRR using the trial and error method. I think this is very clear. So you have to practice it because I gave the answers and I show the way of calculating. Later, you have to do yourself and you have to practice it. Otherwise, in the exam, you will fail, right? You will fail to calculate. Right. So this is IRR of the project L. Simply you have to, in the same way, you have to calculate IRR for the project S. It is 23%, 23.5%. For the project L, 18.13. So now based on the IRR, if the projects are independent, and assume the cost of capital of this project is 10%, right? Just assume the cost of capital or the project required rate of return is 10%. Now my question is, if projects are independent, which you may select?
Both can be selected.
Both you can select because you can see both projects IRRs are greater than the 10%. They are greater than the 10%. So therefore, if they are independent, you can select both. If they are mutually exclusive for the same purpose, then you have to go with the highest IRR project. So you may select the S. You may select the S with the highest IRR rate. Right. So now, rationale for the IRR method, IRR greater than weighted average cost of capital, then project's rate of return is greater than its cost. some return is left over to boost the shareholders return. So simply this is our decision criteria. If IRR is greater than the cost of capital, then we are accepting the project. So why we are accepting project? So it means that return is greater than its cost. So normally in conventional type project, conventional mean initially there is a outflow, after that inflow. So likewise we call it as a traditional conventional type project. In conventional type project, when IRR is greater than the weighted average cost of capital, NPV always positive. No conflict between the NPV and IRR. Right? When NPV IRR is greater than the cost of capital, we accept the project. Why? Return is greater than its cost. Some return is left over to boost shareholders' return. So there is some cash flow, some return to maximize the value, to create the wealth, to get some growth of the company. So that's why we accept the project when IRR is greater than its cost of capital. Create extra return to the shareholders when the IRR is greater than its cost of capital. Normally, when the IRR is less than the cost of capital, in conventional type project, NPV is negative. NPV is negative. When after that only inflow. This kind of projects, this relationship can be there. So no conflict between IRR and NPV. No conflict between IRR and NPV. Right. That's what I explained actually. When IRR is greater than the cost of capital, NPV is greater than the zero. NPV is positive. So we accept the project. So no conflict between the independent project. In the independent project, no conflict. And also when the cost of capital is greater than the IRR, NPV is less than the zero, that means NPV is negative. So in both criteria, recommend you to reject the project. No conflict. This is in case of the independent project. But anyway, so later you can calculate these things, right, for the project. Now we are going to this NPV profile and the multiple IRR issue. Now you can see net present value for the project L and project S in our same example, right? We are on the same example. For the different cost of capital. For the different cost of capital. NPV profile, so we call this as a NPV profile. Is a graphical is a graphical illustration like this. We call this as a NPV profile. It is the project's NPV graphed as a function of various discount rates. So here for the 0, 5%, 10%, 15%, 20%. So likewise NPV for the different rates. So normally NPV we point out in the y-axis and the rate or the discount rate we point out in the x-axis. At zero cost of capital, if you look at here, at zero cost of capital, NPV is simply the total project undiscounted cash flow. NPV is equal to the project cash flows undiscounted. at the 0. So you look at here, 60, 70, 150. Here total is 150. From the 150, 100,000, you can, this is minus no, is outflow no. So then 100 you have to deduct. So that is 50,000. So NPV here, 50,000. At 0 cost of capital, NPV is simply the project total of projects undiscounted cash flow. Even in the here also same. 140 minus 100 is 40,000. So now you can present the NPV profile like this for these two projects. This is for the red line for the project L. This yellow one is for the project S. So here you can see this profile, NPV profiles for project L and S are intersect each at the 8.7%. So we call it as a crossover point or the crossover rate. What is the crossover rate? Crossover rate is the cost of capital at which NPV values of two projects are equal. Now at this rate, at 8.7%, both projects are having the same NPV. It is the point at which the NPV profile of one project crossover or intersect the NPV profile of the other project. So like this, you can see this is the crossover rate. So NPV profiles you can calculate for the different discount rates, NPVs. When you draw in a graphically, so this is the NPV profile for the L, red one. NPV profile for the S is the yellow one. So both projects, if you draw in the one graph, then you can see there is an intersection at 8.7%. So when the cost of capital, is greater than this crossover rate, right? When the cost of capital is greater than this crossover rate, there is no conflict between the IRR and NPV. Now here you can see if the cost of capital here say 15%, then cost of capital is greater than the 8.7. Here then at 15%, NPVS is greater than the NPVL. So no conflict in the NPV. And also if you look at the IRR, NPV IRR is greater than the NPV IRRS is greater than the IRRS is greater than the IRRL. So no conflict. In this range. If it is less than the 8.7, say 5%. Here, 5%. At 5%, if you look at the NPVL here is greater than the NPVS. So on the NPV, you should select the project L. If you look at the IRRS is greater than the IRRL. So you should select the IRR, based on the IRR, you should select the S. So then you can see conflict on NPV and IRR criteria. When cost of capital is less than the crossover rate, NPV IRR criteria, there is a conflict. So you can see when the cost of capital is less than the crossover rate, conflict is there with the NPV and IRR. But when the cost of capital is greater than the crossover rate, no conflict in NPV and IRR. So when taking decision, what is the reason for that? Before that, what is the reason? Reason is, I told you that when we do the NPV and IRR discussion, in the NPV, our reinvestment assumption is cost of capital. We reinvest cash flows at the cost of capital. In IRR calculation, we reinvest the cash flows at IRR. So therefore, because of this difference in reinvestment rate, the basic cause of the conflicts is differing reinvestment rate assumption between the NPV and IRR. NPV, we assume that we are reinvesting at the cost of capital. In the IRR, we assume that we are reinvesting at the IRR. So because of this reinvestment assumption difference, this happened. This is happening. NPV assume that cash flows can be reinvested at the cost of capital, whereas the IRR assume that reinvestment yields the higher IRR. The higher reinvestment rate assumption under the IRR makes early cash flows especially valuable. So short-term projects look better under the IRRs with the higher rates. Because IRR is higher than the cost of capital now. So when the cost of capital is higher rates, so no conflict. No conflict between the IRR and NPV. But when the cost of capital is lower rate, but the NPV is, when the cost of capital is lower rate, but the IRR is the higher rate, so there is a conflict because of this reinvestment rate assumption. So when such a things are happen, so you will make a difficulty when you are selecting the project. To overcome this, we can use modified internal rate of return. Later we discuss the modified internal rate of return. So then we can apply the modified internal rate of return when there is a conflict. That you can compare with the cost of capital. Reinvest at opportunity cost is more realistic. But anyway, remember that we using two assumptions, but reinvestment at the opportunity, that is cost of capital. Reinvestment at cost of capital is the more realistic one. When we calculate the modified internal rate of return in next, reinvestment assumption is cost of capital. So that is more realistic one. IRR එක මත reinvest කරනවා කියන එක realistic නෑ. Market එකේ interest rate එකනේ cost of capital එක කියලා කියන්නේ. ඒ තමයි prevailing required rate of return එක. So therefore that is the more realistic one. So assumption to reinvest at the IRR is not realistic. So because of these two assumptions, this conflict is arise in here when the cost of capital is less than the crossover rate. But when the cost of capital is greater than this crossover rate, no conflict because it's close to the IRR, cost of capital. It's a higher rate. This crossover rate is the point where both projects are having the same NPV. So NPV method is best. It select the projects that add the most to shareholder wealth. NPV should be used to choose the. So our conclusion actually, we should select project based on the NPV because it is theoretically very strong method. It shows how much you can add to wealth or value of the shareholder once you select the project. So therefore, we normally take the decision based on the NPV. Even this IRR and NPV conflicts can be there, but anyway, you have to take the decision based on the NPV. Once you calculate the MIRR or modified internal rate of return here, so you can sort out this issue. So you will end up with the NPV decision, right? Later with the example also I have put on this discussion so you can understand this thing, right? Right. So then shall we move to this modified internal rate of return? So actually before going to the modified internal rate of return, normal cash flow project and non-normal. This is we call conventional project. This is we call non-conventional project. So this is a normal project. See, In the normal type of project, right, cost or the negative cash flow followed by a series of positive cash flows. One change of sign is possible. Now here, this is the example for the normal, one change in sign. During the project lifetime, the sign or the inflow outflow sign mean they are changing for one sign, one way, one time. Negative, positive. Negative, positive. There is a 3 years investment in this one. It means non-normal or non-conventional projects mean 2 or more changes of signs. Now here, cash outflow, increase 4 cash flows, 4 years, again outflow. More than one change of sign. Here, outflow, 3 inflows, outflow, 3 inflows. So therefore, when there is a non-conventional or this kind of projects, if you calculate the IRR for this kind of projects, sometimes there may be 2 IRR, more than one. There may be 2 places where the NPV is 0. When you look at this non-conventional type project. See this illustration. This is the cash flow of this project, right? This is actually extracted from your textbooks, your recommended textbooks. Now, if you look at here, you can see 2 IRR is there. IRR 1 at 25%, IRR 2 at the 400,000. 400%. So now in such a non-conventional type project, evaluating like using NPV, IRR is very difficult. So now 2 IRRs, multiple IRR problem, we call multiple IRR problem. So in such situation, what you have to do? Now this is multiple IRR issue. This is MPV profile, no? This is MPV profile. In the NPV profile, you can see 2 point where NPV is 0. Now here cost of capital is 10%. So if you compare this with the IRR, project is rejected. Not rejected, you can accept because higher rate than the 10%. But anyway, there is a conflict. So in such a situation, you can calculate this MIRR. We call modified internal rate of return. Modified internal rate of return. So modified internal rate of return is the discount rate which present value of the project's terminal value, or which present value of the project terminal value equal to the present value of the cost. So it is the point where the terminal present value of the project terminal cash flow is equal to the cost of the project. Is the discount rate where project's terminal cash flow, project all the cash flows we convert into the terminal year. Project එකේ අපි ඔක්කොම cash flows ටික terminal year එකට අරන් ගිහිල්ලා ඒ terminal year cash flow එකයි cost එකයි සමාන වෙන වෙලාවේ discount rate එකට තමයි simply we call the modified internal rate of return. Now IRR mean that is the point where NPV is 0. No? Now this modified internal rate of return is the discount rate which causes the present value of the project's terminal value to equal to the present value of its cost. When we estimate the modified internal rate of return, we assume that cash flows are reinvesting at weighted average cost of capital. So reinvestment assumption here, not IRR, not modified IRR, it is cost of capital. Cash flows reinvested at IRR. The terminal value is found by compounding inflows at weighted average cost of capital. So terminal value or the cash flows at the terminal year, we convert, calculate compounding. You know what is compounding? We go to the forward in the timeline to the terminal year. So we compound cash flows at the cost of capital. Because our implied assumption is cost of capital. Reinvestment rate is cost of capital. Now look at the modified internal rate of return for the project. Our example, project L. So now here, first is 100,000, 10,000, 60,000, 80,000. So now you have to work out the terminal year cash flow. So simply what you have to do, 80,000 is the end of year 3. So you can take it as it is. 80,000, you can take it as it is. Actually, we are calculating modified internal rate of return because IRR sometimes generate multiple IRR. Sometimes IRR of the project, normally for the non-conventional project, sometimes there may be a 2 IRR. So because of that, to overcome this kind of issue, this is an issue in the capital budgeting. So we use the modified internal rate of return. Now, here I am explaining how we estimate the modified internal rate of return. Modified internal rate of return means it is the discount rate where the terminal year cash flows are equal to the cost. All the cash flows of the project we compound into the terminal year. That total, then we calculate the discount rate where this terminal year cash flows are equal to the cost. That is, we call the MIRR. When we calculate this modified internal rate of return, we use the cost of capital of the project. But remember, when we calculate the IRR, our reinvestment assumption was IRR. It is not realistic. So therefore, I think with this one also, when you draw this kind of things, NPV2, when you compare the two NPVs profiles of the two projects, you can see here, when cost of capital is less than this crossover rate, conflict is there with the IRR and NPV. When the cost of capital is greater than the crossover rate is no issue. But anyway, when the cost of capital is less than this one, there is a conflict if the projects are mutually exclusive, right? If the projects are mutually exclusive. So overcome this kind of issue, you can work out the modified internal rate of return. Then you can look at the modified internal rate of return or the MIRR and the NPV of the projects. You can take the decision. So modified internal rate of return, you can calculate. Now here you can see terminal year cash flows you are calculating by compounding. You know what is compounding? No? So here, this 80,000 you can take as it is. 60,000 you have to compound by 1.1 into the power 1. So that is 66,000. 66,000. Then this 10,000 1 year from today. So you have to compound for 2 years. 1, 2. To take the compound value at the end of year 3, you have to compound this for the 2 years. So 10,000 into 1.1 into the power 2. So it is then 12.1 or 12,100, or we can call this as this is 80,000, this is 66,000, this is 12,100. Then total of this is 158,000. So this is the terminal year cash flows of the project. All the cash flows now you have converted to the terminal year. Now you can work out the modified internal rate of return. So modified internal rate of return is the discount rate where this terminal year cash flow is equal to the cost of the project. So you can solve this one, 100 equal, this is 100,000 divide by 1 plus MIRR modified internal rate into the power 3, because here 3, because life time of the investment or the project life is 3 years. Now you can solve this. Here you can cross multiplication, you can use the cross multiplication into 1 plus MIRR into the power 3 is equal 158,100. Then in order to remove this 3, or we can you can balance the 1 plus MIRR here. I am simply is equal 158,100 divided by 100,000. So that is 158,000.1. Then you have to remove this 3. How to remove this? You have to multiply both sides by 1 over 3. So 1 over 3 means you have to take here 3 square root of 158.1 is equal 1 plus MIRR. Then MIRR is equal, you have to deduct the 1. So then you will get this one, 16.5. This is the modified internal rate of return for the project L.
Madam, there are 158,100 divided by 100. The answer is 1.581, no? Not 158.1.
Yes. This is 1.581. Then square root of 3. How much the answer? Square root of 3. 3 is 100. 3 square root of 100.58.
1.1649.
Yes, correct. No, 1.1649. If you're making a kadunaham, me 16.4. So your answer will be 16.5 approximately. So this is the modified internal rate of return. So then you can compare this one with the cost of capital of the project. So now this is very realistic, because here throughout this project, we assume that cash flows are reinvested at the modified internal rate of return. So why use modified internal rate of return versus IRR? MIRR correctly assume reinvestment at opportunity cost or the cost of capital. So this is the market expectation, at the point or the current market expectation. So therefore, this is more realistic than reinvesting at the IRR. It is beyond the market, is far away on the market. MIR also avoids the problem of multiple IRR problem. Now here, no issue of the multiple IRR. Even whatever the cash flows are there in this between the project, you will get only the one MIRR. But anyway, when the cash flow patterns are not normal like this, so there is a problem of multiple IRR. So there is a 2 IRRs. But with the MIRR, no that issue. So then you can sort out, you can resolve that MIRR problem, multiple IRR problem. If management wants to know the rate of return on projects, the MIRR is better estimate than the regular IRR. So it says that if you want to know the rate of return of the project, it says that MIRR is better, because MIRR assume that cash flows are reinvested at the cost of capital. So based on that assumption, we are coming to the realistic point. Managers like rate of return comparison and MIRR is better than the this IRR. If you want to rate comparison, you better to compare the MIRR with the market interest rate or the cost of capital or the required rate of return. Now look at this example. This is different from the previous example. Suppose separate projects A and B. Project A estimated to be average risk, so the cost of capital is 10%. Right? So 0, 1, 2, 3 years, 2 years project. Initial cost both 10,000. You are given the year 1 cash flows and which provides better estimate of project's true rate of return. MIRR. All right. What you have to do, I'm asking, which provides better estimate of project's true rate of return, MIRR or the IRR. So here what you have to do, what I expect, calculate IRR and calculate MIRR and also calculate the NPV and come with the numbers. Then I will show you that conflict, because NPV say project A is or the B is good, but IRR say another project. So now conflict is there. So then you have to go with the MIRR to resolve the issue. So first what you have to do, you calculate NPV, IRR and MIRR. So then we can discuss. I will let you 5 minutes, just quickly calculate the MIRR, IRR and the NPV. So two projects, investment is 1,000. Project 1, say this is A, this is B. Again 1,000. Cost is 1,050, year 1, 100, 100, 0. You can calculate this one using the Excel even, right? I will show you that one. Now here actually one point I would like to emphasize again here. Now here you identify by graphing the NPV profiles, you identify the crossover rate. So with the crossover rate, because one of you have asked me a question personally to the chat box, when the cost of capital is less than this crossover rate, so conflict is arising. Because NPV say this project is correct, IRR say this project is correct. So the conflict is there when the cost of capital goes beyond the crossover rate. Less than the crossover rate. ඒ කියන්නේ left side එකේදී මේ පැත්තේදී. එතකොට to take the decisions what you have to do, now if you calculate modified internal rate of return at 5%, now at the 5% there is a conflict, no? Then මෙතන cost of capital 5% වෙනකොට now you are facing to the conflict. Now if you calculate modified internal rate of return at 5%, simply later at the home you can do that. You can calculate modified internal rate of return at 5%. So then you can see there is no conflict. NPV and the modified internal rate of return is, if the modified internal rate of returns are consistent. So then you can take the decision based on the modified internal rate of return. In case if actually that is not happening when the crossover rate, when the cost of capital is less than the crossover rate, normally you can see NPV L is greater than the NPV S, but IRR S is greater than the IRR L. But when you calculate here modified internal rate of return, you will see modified internal rate of return L is greater than the modified internal rate of return S. So then no conflict. So here you can apply the modified internal rate of return. So that's what I emphasize here. Now here in this example, actually we can go to the Excel even, simply using the Excel all you can calculate. Now here, yes, for the conventional type project, you can go with the NPV, no issue. But I am talking about the non-conventional type project. දැන් මේ අපි කතා කරන මේ අවුරුදු දෙකේ project මේ practical world එකේ තියෙනවා. මම simply realistically මේ capital budgeting කියන එකේ තව කොච්චර දේවල් තියෙනවද කියන එක තමයි පෙන්නන්නේ. So that kind of a project always you can't expect. You can't expect. There is a non-conventional type projects. Cash flow, sign of the cash flows, inflows, outflows are changing time to time. So if that kind of things are happened, so you can't take decision really based on the NPV. Then IRR issue is there. If the multiple IRR or IRR එකෙන් දෙන project එක NPV එකත් එක්ක align වෙන්නේ නැත්නම්, you have to check with the MIRR. Then if MIRR and NPV is okay, if both are consist, then no issue, you can go with the NPV. So that is why we calculate the MIRR and check whether NPV and MIRR are consist. Either the consist, no issue, you can conclude with the NPV. පැහැදිලිද? දැන් මෙතන මේ IRR එකයි NPV එකයි අතර conflict එකක් ඇති වෙනකොට අපිට decision එක ගන්න බෑ. NPV එක තමයි best. එහෙම පුළුවන්. නමුත් මේක non conventional type project එකක් නම් අපි MIRR එක calculate කරලා බලනවා එතනත් ඒකයි NPV එකයි consistent වෙනවද කියලා. either consistency no issue, you can take the decision with the NPV. If there is no consistency, so there is another treatment. So I think that's advanced area in the capital budgeting. So again, finally you can end up with the capital NPV based on the certain assumption, but anyway most of the time MIRR and NPV is consistent. Now here you can calculate NPV simply. I think discount rate was how much? 10%, no? Yes, it is 10%. So simply work out the present value factors at 10%. Have you calculated NPV? This is 1.1 into the power, say -1. අවල හදලා තියෙන්නේ මෙතන එතකොට 2 වෙනවා. This is 2. Oh, sorry. This is 1. This is 2. This is 3. So NPV simply you can calculate for the project A. This into, this is 1000. No need to do this, you can do by yourself even. So NPV is 128. Right, correct. So here project B NPV it is 165, right? Correct. 165, 100. Correct. Now IRR, you can calculate IRR. I am using function here. IRR is equal for the project A. $23.1. Project B IRR 19.1. So MIRR, even MIRR you can get the from Excel function, right? MIRR, here in the function there is MI multiplied internal rate of return values. This financing rate 10%, reinvest rate 10%, then 17% MIRR for the project A, then MIRR for the project B, values 10%. Right, 19%. So you will get the answers like this. I think in your chat box, I can see you have get these values correct. So now, if you look at the answers, this MIRR using that formula also you can calculate. I have put here, right? You are getting the same answer, right? No, without the Excel function, you can get the terminal cash flows, and then you can calculate the equivalent rate terminal cash flows to the cost. So that also 16.8. This is for the A. So this way also you can get, right? For the exam, you can use this one. So those are the values. So now if you look at the NPV and IRR, there is a conflict. There is a conflict. NPV suggests project B, IRR suggests project A. So conflict is there between the NPV and IRR. Now you can take decision based on the NPV, but anyway, if it is to have a more confident, if it is a non-conventional type project even, so then you can look at the MIRR. So if you calculate the modified internal rate of return based on the reinvestment assumption cost of capital, so you can see project B is the recommending one. So now you can see NPV and MIR are aligned in each. They are consistent. So therefore, you can select the project B based on these two criteria. So likewise, this modified internal rate of return you can calculate when there is a conflict between the NPV and IRR. Right. So then next one is the profitability index. So profitability index also another valuation criteria that is based on the present value of the future cash flows, time value adjusted or the discounted cash flow based method. It shows the relative profitability of the project, or it shows the present value for rupee of invested. Value for the rupee of invested. So this is relative measure. Using the profitability index, you can get some idea about the relative measure of the wealth, because it shows present value for 1 rupee invested. How we calculate the profitability index? Profitability index is the present value of the future cash flows divided by its cost. Present value of the cash inflows divided by its cost. So that is we call cost benefit ratio sometime. So it shows the profit or the return for 1 rupee invested. So that is why we call it a relative profitability of the project. It shows the rupiyalakata wealth එක. So that kind of a indicator. Now, if you look at the profitability index for the here our previous example, present value of the future cash flow divided by initial cost. So you have to work out the present value of these three cash flows. Earlier we calculated at the 10%. So it is 118.79. So it divide by the cost. Then profitability index is 1.19. Value for 1 rupee invested. So yeah, it's creating when the profitability index is greater than 1. When it is greater than 1, profitability index is when greater than 1, it means value wealth creating. We accept the project when the profitability index is greater than 1. When the probability index is less than 1, we reject normally projects because it decrease the wealth. Because රුපියලක් ඉන්වෙස්ට් කරපුවම wealth එකක් create වෙන්නේ නැහැ 1 point එකට වඩා අඩුයි කියලා කියන්නේ 1 point something means that's create the value. If it is 1, no creation, no decreasing, no creation value. So when the profitability index is greater than 1, so normally we accept the project. If you invested 1 rupee, your wealth is created 0.09. This is the present value for 1 rupee invested. Now, if you calculate the similar way, if you calculate the profitability index for our project X, it is 1.2. 1.2. So you can see both are greater than 1. So both projects you can accept based on the profitability index. Normally, if the projects are independent, we can accept both. If they are mutually exclusive, so you may select the one with the highest profitability index. This profitability index is very important when there is a capital rationing. What is capital rationing? It is the fund constraint. We have so many projects with the positive NPVs, but our investment budget is limited. We have only the 1 million. Say that kind of situation we call fund constraint. So when there is a capital rationing or the fund constraint, so you can rank the project based on profitability index. So you can rank the project based on the profitability index, and then you select the project based on highest profitability index, because this profitability index shows you wealth creation for 1 rupee invested. එක රුපියලක් invest කරොත් මේකෙන් කොච්චරක් ක්‍රියේට් කරනවද? එක රුපියලකට මේ ප්‍රොජෙක්ට් එකෙන් කීයක්ද? So therefore, it shows the relative measure of the wealth. This is actually the relative measure of the wealth. So you may rank the project based on the profitability index, and you may select from the top with the limited budget. With a limited budget, you have only the 1 million. So then you can't do all the projects, but anyway, you may rank based on the profitability index. So normally, in conclusion, what could say in conventional type projects, normal project, NPV, IRR, MIRR, profitability index always lead to the same accept reject decision for the normal independent projects. So therefore, they are all consistent in the normal project. If project's NPV positive, its IRR, MIR always exceed the cost of capital. And also profitability index always greater than the 1 in the normal projects. However, normal independent projects, however, these methods can give conflict in rankings for the mutually exclusive project if the projects are differ in size or in timing of the cash flow. Say one project investment is 1 million, other project investment is say 2 million. So if they are differ in size, so there may be a conflict. Making you have to you can understand that there are a lot of things we have to discuss beyond this capital budgeting when the initial investment is differ, how we apply these techniques. When the life or the time of the projects are differ, one project is 6 years, other one is 12 years. So can you apply this one as it is? You have to do some adjustment for this kind of things, these differences. In the independent projects, you won't be a problem. But anyway, when there is a mutual exclusive projects, the comparison is very difficult when size is differ and when the timing of the cash flows are differ. So kind of things can consider. But anyway, in the conventional type projects, always this NPV, IRR, MIR, profitability are linear. They are consistent. Right. So now I am going to the example I have given you. I think with the time, I think I can manage this one. This one. I think you may have your PowerPoints also. Assume you are given the following two proposed investment projects X and Y. Each project has cost 10,000 and cost of capital 12%. The project's expected net cash flows are follows. So you are given two projects X and Y. Initial cost 10,000. Here net cash flows for the 4 years. What you have to do, calculate each project's payback period, NPV, IRR, MIRR, and profitability index. So you can do now. You can calculate payback, NPV, IRR, MIRR, and profitability index. Which project or project should be accepted if they are independent? So you have to list the project you may accept if they are independent based on NPV, IRR. So you have to prepare a table, right? So you can put the NPV, IRR, and criteria to the one side, and you can put whether you accept or not. Like this, you can do analysis. In your slides, it's not there.
It's there, madam.
One of you have. It's not there, Kilatina. Okay. I think I remember I put the question. Right. So then you have to select the project based on if it is independent. Which project or projects should be accepted if they are mutually exclusive? How might a change of the cost of capital, this is actually the mutually exclusive. Then next question, right? This is next question. How might change of the cost of capital produce conflict between NPV, IRR rankings of these projects? So in order to answer this question, how might change of cost of capital produce conflict between NPV and IRR? So what you have to do, you have to develop or you have to draw NPV profiles for this project. Project X and project Y for the different rates of return. So this is 10%, sorry, 12%. So you can start with the 0, 3%, 4%, 8%, 12%. Any scale you can use, and you calculate the NPV and for the project S and project Y, and prepare the NPV profiles. How might change in the cost of capital produce conflict between the NPV and IRR rankings of these projects? So in order to answer this question, you have to draw you have to plot the NPV profiles for the project, and then identify the crossover rate for these two projects. එතකොට මේක ඇවිල්ලා මේ මෙතන next question එක. එතකොට මේකට answer කරන්න, so you have to plot the profiles X and Y. Then once you plot the profiles of the X and Y, you can see where the crossover rate. So the question is asked, how might change in the cost of capital produce conflict? So you can answer, when the cost of capital is less than this crossover rate, there is a conflict between NPV and IRR. අපි හිතමු crossover rate එක 108ක් කියලා ආව කියලා. ඒතකොට cost of capital එක 100ට වඩා අඩු වෙන අවස්ථාවලදී NPV and IRR conflict එකක් තියෙනවා. But when the cost of capital is greater than this crossover rate, no conflict. So likewise, you can answer the question. It starts, would conflict exist if cost of capital were 5%? So in order to answer this question, you should know what is the crossover rate. If this is less than the crossover rate, yes, conflict exists. If this is greater than the crossover rate, no conflict. So why does the conflict exist? I explained. The conflict arises because of the different reinvestment assumption. NPV assume reinvestment at the cost of capital. IRR assume reinvestment at the IRR. So therefore, at a lower rate, so normally when the cost of capital less than the crossover rate, conflict can arise at the lower rates. But when with the higher rates, benchmark is when it is when the rate is greater than the crossover rate, no conflict. So likewise, this is arise because of this reinvestment assumption, because of that different in the reinvestment assumption. So likewise, you have to answer. So this is homework. So through all the discussions are included here, even we started from the payback period to the profitability index. So you have to calculate them. So you have to be able to do this kind of a question. So can you do, anyone who has the confidence that you can do this by yourself is better. If you have that confidence, so it means that you realize the things. If you can. Any questions or any clarification on this question? Because in the classroom, actually, if it is physical one, we can do using a backboard and the things. But anyway, with this mode, it's very difficult to do the examples. But anyway, you can do by yourself and you can give me the answer. Then I can check the answers and I can evaluate. Any questions on this question? So you can calculate. Oh, yes.
Madam, I think it's manageable after watching the video again.
Yes.
So anyway, are we getting questions like these examples that we discussed?
Yes, definitely.
Okay, madam. Thank you.
I will tell you the answers. You can write down and you can check your answers with the, once you've done this. Payback period X, you can write down 2 years and 2 years and 2 months around. Payback Y, 2 years and 9 months. NPV X 966, NPV Y 630, approximately 630.7 something. IRRX 18%, IRRY 15%, modified internal rate of return X 14.61%, Y 13.73%, profitability index X 1.097, profitability index Y 1.063. Then you can draw the NPV profiles using the rates like 4, 8, 12, 6 or any scale. So you will have the crossover rate about 6.2%, crossover rate about 6.2%. Now, actually, I extracted this from your recommended textbooks. Now here, if you draw this NPV profiles, you can see crossover rate is around 6.2%. In the question you asked, at the 5%, what would happen? At the 5%, then what, are there any conflict or not?
There is a conflict, madam.
There is a conflict because it's less than crossover rate. So therefore, in order to resolve this conflict, you can calculate MIRR at the 5%. At the 5% cost of level, you calculate the MIRR. So if you calculate the modified internal rate of return at 5% for the X 10.64, so Y 10.83. So now you can see Y is greater than the X. Now here NPV also Y greater than the X. So therefore, hence the modified IRR ranks the project correctly even if R is to the left of the crossover. The modified internal rate of return decision. So that's what I want to exhibit. So for the exam, you have to ready for such a question, right? මේ වගේ level එකකට ඔයාලා last වෙලා ඉන්න ඕන exam එකේ in order to answer. Right. Okay. Now actually we have to discuss certain things related to the special application of the cash flow evaluation. So we know that when the projects are having unequal lives, that means one project is having say 2 years of life, say other one is having 4 years of life, right? As I expected, I experienced the power cut. It was around 10:30, but anyway it goes up to the 10:40. So what I can do? Actually, I'm experiencing power cut. What I have to do, because I think within the power cut, within next 10 minutes time, network also down. So I may not continue this thing for the end. So what I suggest is I will record these things for you. I will upload the recordings related to these calculations. Are you agree with me? Because no way to continue more than 10-20 minutes.
Okay, madam.
Because
Okay,
with the power cuts, actually, I have my battery to continue, but anyway, within next 10-15 minutes, network is problem.
Yes, madam.
Okay, madam.
Okay. Then I will upload the recording and you have to continue this thing with the previous thing. You have to complete. If you have any questions, any clarifications, you can drop me an email. I will answer. Even you may have my contacts also. You can clarify the things.
Okay, madam.
Okay, then thank you very much for bearing. So we'll meet with the recording. Thank you.
Madam, thank you so much. One question at the end.
Okay.
In the question paper, how much of questions that you are going to give from your area?
I will give question on the risk and return, and also one question from the cost of capital and capital budgeting. Maybe 2 questions.
Okay, madam. Thank you so much.
Okay.